Guys, it is easy to get swept up in the excitement over stocks like Nvidia or Palantir when they're having an incredible run. And don't get me wrong, if you pick the right stock at the right price, you can make a ton of money. But you know what I think is even sexier than that? Finding a stock that the market overlooks and getting in at a great price when all the signs point to huge potential growth because of incredible potential fundamentals. Let me show you what I'm talking about. Now, guys, this video is about 3 high potential stocks that everyone's overlooking. This is my opinion. You can take it for what you want. You can apply it to your own life. But these are just thoughts I have that might be able to spark some good conversation and some thought for you. And remember, we never buy based on price. We buy when price is below value. That's the true sign of a value investor. The great part is these stocks, I think, might fit that bill. Stock number 1, Uber. So guys, Uber was a high-flying tech stock for a very, very long time. Very few companies can claim to have changed an entire industry. This company changed an entire industry. Literally, we went from cabs to Uber. When I have been in cabs and see the anger in their face, and they'll sit there and say whatever they need to say to discredit Uber. Do you ever take Uber? Yeah, I have. Oh, so I guess you're okay getting murdered and robbed. And I was like, what? That actually happened to me in San Diego. A cab driver actually said that to me. He said, oh, all my friends are cops. They tell me all the time they have to go save people's lives because an Uber driver is murdering them. And I was like, what are you talking about? But this is what the world is made of. You guys got to think of Uber as more than just a ride-hailing app because they're expanding into so many different areas. It's becoming a complete transportation and delivery platform with several ways to make money and grow. Now, don't forget, though, there are issues with it. Look at Google. They have Waymo. It is self-driving. But what's driving Uber's growth? Well, the core business is expanding. More people are using rideshare services instead of owning cars. Food delivery has exploded since COVID and keeps growing. And Uber dominates in most of the key markets that they're in, not just in the US, worldwide. And guys, Uber has a ton of new money-making opportunities. 1, advertising. Companies pay Uber to show ads in the app. This is a very high margin business because once they've built the platform, the rest of it's all profit. Okay, there's retail partnerships. They now do deliveries for stores like Best Buy and Dollar Tree, not just restaurants. And that helps companies like Best Buy, the ones that are fighting Amazon. They want to make it so easy that people can order from Best Buy and get their product immediately. Now, what's the big future play? Well, I talked about Waymo, but they have their own self-driving cars. Right now, Uber pays its drivers about 75% of each fare. With self-driving vehicles, autonomous vehicles, they would have to decrease the price, but they're going to keep 100% of that money. Analysts believe that the profit's going to grow. Right now, they have it growing 50% in the next 4 years and revenue growing 8 to 17% a year for the next 4 years. The company is generating very solid cash flow, and their current target is to convert 90% of its EBITDA into free cash flow. And think of EBITDA as basically the profit of the business. Now, guys, if you care about Wall Street analysts, most of them rate Uber a buy. But you know how I feel about Wall Street analysts. And if you don't, it's not very good. They have they actually have worse biases than we do out here because they have to sit there and be part of the crowd. And guys, that super investor Bill Ackman, he made $1 billion bet on Uber. Now, the bottom line is Uber's transforming from a simple ride app into a comprehensive platform for moving people and stuff around. While there's always risk with any stock, the company has multiple ways to grow and could see a major profit boost if self-driving technology takes off. So guys, let's take a look at Uber's 8 pillars. Remember, the 8 pillars are just to tell a story. Because look, everything here is an X except for the obvious revenue growth, net income growth, free cash flow growth. Everything else looks expensive. But I want you to keep in mind, look at this 5-year price of free cash flow. This takes the average of their free cash flow the last 5 years, which is right here, $2.6 billion. So this 76 seems very high. But guys, last year's is 8.54. So if they're just going to keep that steady and grow it, don't even worry about the 5-year. Just look at the 1 year. And 23 times free cash flow ain't the worst thing in the world when you have a company that can grow its profit pretty substantially. Right now, their gross margin is 40%. That means for every dollar they bring in, 40% of it, 40 cents, will go to the bottom line before paying taxes and overhead costs like offices and employees. But remember, if they do self-driving, that gross margin will go up. And they'll probably have a lot less hassles having to deal with employees. And guys, another thing I love, it shows their debt being high, again, because compared to their 5-year free cash flow. Over triple it, and that 7.47 falls to around 2. This is a check mark then. This one becomes a check mark. All these things become check marks. What's interesting is their 5-year return on capital is negative 5.5%. Last year, 4.78. Not a great number, but getting better. Now remember, if you're new to the channel, if you're new to investing, I want you to remember, you're not alone if you feel overwhelmed. We're here to try to simplify this as much as possible. In fact, if there's something you don't understand, put it in the comments below so we know to make note of it in future videos. But the bottom line is you should look at every company like you'd look at your own personal life. How much money is coming in? How much money is going out? How much debt do you have? Etc. What's your earnings potential? If you're a 70-year-old working somewhere versus a 25-year-old, who has more earnings potential? These are the things to consider as time goes on in every company you look at. Now, guys, you might have found this video because a friend of yours said a stock recommendation, YouTube saw it and suggested this video to you. Awesome. I will tell you this. The things we're going to talk about in this video is going to be hard to find anywhere else on YouTube because most of the other big finance channels, they're just talking about general high-level ideas that are not going to make you any more money. You're here to learn and level up your investing game. That's what this does. And all these metrics are super important to understand. And I want you to understand these. So if you want to get better investing, whether you're new or even more advanced, click the link below. We have the free PDF. It'll tell you all of these metrics and explain it to you thoroughly so you can have it for the rest of your life absolutely free. So in a couple of minutes, we're going to go over Uber's value using our stock analyzer tool. We went over our analyst estimates. We went over these key metrics here. One key metric I want to show you guys is this, though. Look at the growth rate. Revenue growth of 23% a year for the last 3 years, 32% a year for the last 5 years. Guys, only $2 billion in acquisitions. Now, if you're out there saying $2 billion is a lot of money, it's not. Their market cap is $200 billion. It's 1% of their market cap in acquisitions over the last 5 years. And their free cash flow last year was $8.5 billion. Guys, this is a company that's growing on its own. And the thing I love about their CEO is a few years ago, he said, hey, guess what? The market's changed. We need to focus on cash flow. And that's what he did. And he's done a tremendous job of doing that. Oh, look at this. We have 40 community members that have voted on the stock, and the average rating is a buy. 5% at sell, the rest are hold or buy. A couple are strong buy, several strong buy. Things to consider going forward. So guys, we have the story. Uber's got a bright future. There's no doubt about that. The future of self-driving is going to be there. But Uber is the company in rideshare. So if you're going to bet on a company, in my opinion, you got to start by looking at the leader of the market. So we do a 10-year analysis because in our stock analyzer tool, what we're here to do is we're here to project the future. What does the future look like for the company? Now, the future's unknown. We don't know what the future entails, but we can make assumptions that are reasonable. First line, revenue growth. I love it when people say that growth investing and value investing are different. They're not. And if you're new to investing and new to the channel, you're probably like, wait, I thought they were different. They're not. Proof, revenue growth is the very first thing I talk about. I did a 10-year analysis. I did 5, 8, and 11%. Now, guys, you might sit there and say, Paul, that's so low. Maybe, but I want to be a little more conservative. But if you want to change these, by all means, get in the software and go change it. Profit margin. Now, this is harder because look at these big jumps. They did 2% a year for the last 5 years. They did 27% last year. For free cash flow, they did 8% a year for the last 5 years, 18% over the last 1 year. So I did 12, 18, and 24% for both profit margin and free cash flow. Is this right? I don't know. It could be better, but with 40% gross margin before all their taxes and overhead, this seems like it's probably pretty good for the high side because they might be able to increase their margins by doing self-driving, etc. Next two things. What are the price to free cash flow and PE 10 years from now? This is a very common question. Paul, what's the right answer? This is what I say. First off, we don't know the right answer, but the market average is 15 or 16. I'd recommend going up or down from this based on how good a company this is. Guys, Uber is the leader. Their return on capital is getting better, which means when they invest money into the business, they do very well with it. That deserves a premium. They're the verb, Uber. So I think this is a premium company. So I actually put in 18, 22, and 26. You might think it's too low. You might think it's too high. That's the beauty of investing. It's not some cookie cutter thing. And finally, what's our desired return here? Guys, what do you want to make on Uber? I put in 9%. Not because that's what I want to earn. Because for the video, I want to show you what I think the company's value is. And I'm going to do that for the another 2 stocks that we do in this video. But remember, you need a margin of safety because the future is unknown and we're humans and make mistakes. So you need to have a number higher than this. How much higher? Depends on how comfortable you feel with Uber. If you're not very comfortable, maybe 15 to 20%. If you're very comfortable, maybe 11 to 14%. It all depends on you. But this number right here is going to give me my intrinsic value. So I hit the analyze button and I have a low price of 50, a high price of 220, middle price of 115. Guys, wide range. Why? Because we have wide ranges above, but don't let that scare you. Use this to your advantage. Guys, if you paid today's price and the middle assumptions above occur, you're going to make about 11.5% return on your money. Pretty solid. Is it enough for you? That's the question. Stock number 2, Google, the googly moogly. Google isn't just a search engine anymore, guys. It's betting big on the future of technology, and that could mean some serious growth potential for investors and for the company. So what's driving Google's growth? Google is leading the artificial intelligence, the AI race, with tools that make search much smarter and help businesses. Their AI technology is built into everything they do. This makes their services even more valuable. Google Cloud is growing fast as companies need powerful computers to run AI. This is what people don't realize, how much energy and how much computer space it takes to run AI. This is a massively huge and profitable business that's still expanding very rapidly for Google. Now, we talked about in the previous company, Waymo. They've already given millions of paid rides, and it could be absolutely massive if autonomous vehicles take off. And guys, my opinion is they absolutely will. Now, analysts expect that Google's earnings will grow by double digits every year. Some say even up to 20%. And when you have such high margin, like Google's gross margin here is almost 60%. Remember, Uber's was 40. That's a big difference, guys. And when your fixed costs are pretty set, you look right here, their 5-year profit margin is 27%, 1 year is 31%. Because when you have a high gross margin and you're able to grow your revenue fast, that's going to drive up your profit margin even more. Google is investing billions of dollars into AI and quantum computing, which in the short run will reduce short-term cash flow. Now, they also have antitrust investigations that could force Google to change how it operates. And they also have a lot of competition, especially cloud computing. You got Amazon, you got Microsoft, you got Oracle, and then OpenAI is fighting really hard for AI dominance. The bottom line is Google is placing massive bets on tomorrow's technology. If AI, autonomous vehicles, and quantum computing take off, Google will absolutely see growth, even if they're not getting the big chunk of that growth. And guys, the regulatory stuff has gotten better as of late for not having to split off Chrome, but they're not out of the woodwork yet. Doesn't mean that it's going to happen, but it's just something to consider. So with Google, they have an adorable little dividend here of 0.32%. But guess what? That small dividend, because of how big the company's worth, it's $10 billion a year that it costs them. Good news is they make $65 billion a year in free cash flow. So they can easily afford this dividend. It's only 15% of their cash flow. That's something that I want, especially new investors, to really understand. You got to make sure that the company can afford that dividend. A couple other things. Their free cash flow I talked about, $67 billion, but their net income was $115 billion. Very big difference. Why? Because when you free cash flow is after capital expenditures. What are capital expenditures? Those are the big investments they make into data centers, into all the big stuff that isn't paying off today. That's the big stuff. For a company like Google, usually I don't like it when the gap is that big, but for companies like Google and Amazon and Microsoft, when they're investing a lot in the future, I trust that. I trust that's not, because a lot of times, if you see a big difference between free cash flow and net income, that's an indication of fraud. I doubt that's the case here. Let's go check out their 8 pillar. Oh, by the way, 46 community members rate Google a buy. Interesting. Now, it's had a big run up lately, so maybe they would change their opinion based on the price, because that's over the last 6 months. And in the last 6 months, the stock's up 55%. So keep that in mind when you're looking at our our community stock rating. 8 pillars. I love this. 6 check marks, high return on capital, buying back shares, which is not necessarily a good thing at these price levels. Free cash flow growth, very low debt. It's these, boom, 5-year price of free cash flow, 5-year PE ratio. The good news is their current PE is 27, based on that $115 billion in net income. Okay, so let's see what analysts think about the company. About 70% growth in their profit over the next 4 years, $10.23 to $17.80 per share, and revenue growth growing double digits every year, according to analysts. And guys, as they grow, what's going to happen to their profit? It's going to get even better. Now, guys, Google owns the top 2 search engines in the world, Google.com and this very thing you're on right now, YouTube. You don't Yahoo anything. You don't Bing anything. You don't DuckDuckGo anything. You Google things. This has a strong brand connection. They have great they're an advertising business, essentially, because all that money is made from advertising. I think the future of Google is very, very, very bright. The question is, what does that mean for the price today? You've got to be able to find the right price versus value. That's what matters. So let's start our stock analyzer tool. Let's pull up the last time I did the googly moogly. I did 10-year analysis. I did 4, 8, and 12% revenue growth. Now, if you saw before for analysts, over the next 4 years, they expected 10% growth. I'm going to assume that declines a little bit. Am I being too conservative? Maybe. Let's do this. Let's do 5, 9, and 14% and 13%. Okay? Profit margin. I did 22, 24, and 26. Same thing with free cash flow. Now, maybe I'm being a little conservative because 5 years they did 26, 1 year they did 31. Let's go a little bit higher. Let's do 24, 26, 28. Now, what PE and price of free cash flow 10 years from now? Guys, this is a premium company. Look at these returns on capital, getting better and better. That gives it a premium. Top 2 search engines in the world, that gives it a premium. It's going to be around for a very long time with a great balance sheet. That gives it a premium. I did 20, 23, and 26. And guys, honestly, if you said a higher number than that, I wouldn't blame you. It's a premium business, and we don't know what the right number is. But what I will tell you is this is a premium business. And of course, my 9% desired annual return. Now remember, guys, garbage in, garbage out. You've got to learn how to put the right numbers in the stock analyzer tool. And that's a different way of thinking if you're new to this kind of thought process. Because 25, 30 years ago, I did the same thing that everybody else out there. I didn't do this stuff. I was chasing hot stocks. I was following tips. I got caught up in the hype. My goal was pure and simple. If something sticks, I'm going to make a lot of money. But guess what? That's not investing. I thought it was investing. That's not investing. That's gambling. That is speculation. And that's exactly why we created Everything Money. I wanted to give 25, 30 years ago, Paul, the tools, the strategy, and the community that I never, ever had. And frankly, that wasn't even possible 30 years ago. So when you join Everything Money, you're not just getting the investing software and this famous stock analyzer tool. This thing is used over 1 million times per year by our users. You're getting a strong foundation at understanding investing. We integrate you fully into the community. We advise you on the free courses in our community to watch that we have all the same foundation, and we get you engaged with our like-minded investors who all have one goal: level up their investing so they can make more money. But most importantly, you make more money with the right mindset, the right tools, the right people around you, because the stomach is where you make the money. And even more exciting, we're adding a brokerage to the platform. It is not our brokerage. It is your brokerage. It is going to allow you to take brokerages like Schwab, Vanguard, Robinhood, just a few of those, Fidelity, and put it into the software. That way, when you're ready to buy Google, you just hit buy and it coordinates with your brokerage separately. This is going to make it even easier for you to level up your game. But the most important thing is we only want serious investors to be part of it. I cannot repeat that enough. This is not for people who are chasing the next shiny object. If you're not ready to follow a process and stick with it and put the work in, don't sign up. But I assure you that the journey along the way, you will get better every single week, every single day, every single month. If you're committed to investing the right way, start your 7-day trial below. Click the link, 7 days. We have limited spots, so make sure you sign up. And if you're serious, I will see you in the community. So guys, I hit the analyze button on Google. The stock's currently at 250. Low price of 155, high price of 410, middle price of 253. So right now, it's not like it's a screaming buy to me, but we don't know. If any of these assumptions above are too low, it might make it a great buy today. Now, for the more advanced investor, somebody who's sitting there and knows how to do something called sell puts. If you like Google right now, but you like it at a lower price, you can sell cash secured puts. Don't get worried about that name. The bottom line is you're paid to buy Google at a lower price. This is not some sort of trick. It's absolutely true. Let me give you an example. So let's say you want to buy Google for $240 per share. You'll get $332 per share, which is a 17.5% annualized return, 1.4% between now and the strike date. So you just wait. And if you get the stock, you get it for $240. That's if it falls below $240. And either way, you keep your $3.32 no matter where the stock ends up. So you're getting paid to buy the stock at a lower price. Now, if this sounds interesting to you, stay tuned. This fall, we have a full course on that where we're going to explain how that's done. Final stock, Amazon. Amazon is way more than just online shopping. It's essentially multiple billion-dollar businesses rolled into one company. And that diversity actually has serious growth potential. Their big cash cow is AWS, Amazon Web Services. This is Amazon's cloud computing business. Think of it as renting out super powerful computers to other companies. This very website we have is run on Amazon and AWS. AWS makes huge profits and keeps growing as more businesses move to the cloud. For the record, so does Google. But it's like Amazon's secret money printing machine that many people don't even know about. In fact, from what I've read, Bezos was the only one that wanted to do AWS. His entire team said, do not do it. Same thing with Amazon Prime. Bezos wanted it, everybody else didn't. That is why Bezos is worth $1 trillion, not literally. Guys, when you search for products on Amazon, another way in which you make money, if you see that little word there, let me actually pull one up right here. That is a sponsored ad. Somebody's paying money to be up there. The real first pick is where you don't see sponsored. You think the first top one is natural search. It is not. Amazon's becoming an advertising business and it's exploding. And it's almost pure profit once the platform is built. Now, future growth. Amazon is integrating AI everywhere, from Alexa to helping businesses healthcare. They're trying to disrupt how we get medical care and prescriptions. Guys, Amazon has doctors waiting for you to be able to go on and talk to them about their ailments. How wonderful is that? Not having to wait in line at the doctor, not have to wait the weekend to be able to talk to a doctor at the hospital. It's absolutely changing things. And don't forget, they have Whole Foods and Amazon Fresh, which are just beginning. The Whole Foods is even better because now you just go there, pick up packages, drop them off. It is wonderful. And Prime memberships that I mentioned earlier, they keep customers loyal and spending more. There are over 200 million Prime members worldwide, and they create a steady stream of revenue for the company. Now, of course, most analysts rate Amazon as a strong buy, and Amazon price targets suggest about 13% upside in the next year. But guys, we don't know where it's going to go. What we know about is if you buy at the right price and the fundamentals get better, the stock will eventually go up. The key to success is that Amazon needs to keep growing its most profitable businesses, AWS and advertising, faster than its lower margin retail business. In fact, I would argue, who the F cares about retail? Break even on that one. Keep people coming to Amazon. If they can do that, their profit margins will expand dramatically because they'll be the go-to place for everybody. Spoiler alert, they already are the go-to place for everything. The bottom line is, Amazon is betting on becoming the backbone of how businesses operate through AWS, while also dominating how consumers shop and live. It is a complex company, one in which I did not understand 10 years ago, with multiple ways to win. But success depends on executing across many different industries for this company. So let's look at the 8 pillars here. Ooh, bunch of X's here, bunch of X's. Look at their cash flow growth. It is poop city. It's negative. You know why though? They've taken their capital expenditures, their investment into their company from $20 billion a year to like $65 billion a year. Well, of course their cash flow is down, but it's an investment in the future. That's what I didn't understand 10 or 12 years ago, that growth in its future was going to pay off. They have a 50% gross margin. That's what's incredible. Now, the question becomes, what's a reasonable price to pay? Because guess what? It's looking kind of pricey. 35 times earnings in the last year, 74 times the last 5 years. And guys, you know what the funny part is? The stock has gone nowhere for a while. Not nowhere, but in the last 5 years, until recently, until even as recent as April, it was flat over 5 years almost. And it's had a recent surge in line with the recent NASDAQ surge. But again, we don't care about where the stock goes in the short run. We care about the long run. And analysts believe that profit's basically going to double over the next 4 years from $681 a share to $1358, while revenue is just going to grow double digits for a freaking trillion-dollar company, multi-trillion-dollar company, hitting $1 trillion in revenue in 2029. So my next question is what? What is the right price to pay? So here are my assumptions for Amazon for the next 10 years. I did 4, 7, and 10% revenue growth. Is it reasonable? I don't know. Profit margin? Now keep in mind, the last 10 years, they did 5%. Last 5 years, 6%. Last 1 year, 10%. They're growing AWS. I'm going to change these assumptions here. 8, 12, and 16%. And guys, I do think this could be low, but we'll see. But right now, I look at this going, this will catch up. What's the right PE? Just like Google, I said 20, 23, and 26. Yes, their ROIC is low. For those who don't understand that, again, that's a sign of a premium company. And I do my 9% return. So the stock's currently at $230 per share. I hit the analyze button. I have a low price of 100, high price of 376, middle price of 203. That is based on my assumptions. Am I right? No idea. Am I wrong? No idea. But our goal is to buy great companies at great prices. To me, it doesn't feel like a great price, even with the future potential. Now, it's part of the Mag 7, and the Mag 7 has been killing it for quite some time. But earlier this year, I picked 7 of my own companies that I own to go head-to-head with Magnificent 7, my own personal Magnificent 7. And guess what? My boring companies are winning. I'm not just talking about theory. I'm putting these picks to the test, and they're outperforming the Magnificent 7, the market's biggest name. So click the video on your screen to see which 7 stocks are beating the Magnificent 7 and why I think they'll keep winning for years to come. Thank you for your time.